Okay, well, I guess we'll get started here. We're going to turn our attention now to looking at the natural gas winter outlook. And we have Charles Blanchard, who is the lead natural gas analyst for Bloomberg New Energy Finances. Charlie oversees quantitative research into the gas and LNG markets at Bloomfield News Energy Finance. He's developed models to predict drilling activity and rig movements, coal plant retirements, and energy intensities of several heavy industrial processes. So we'll get a perspective now on natural gas for the coming winter.
Thank you. So I'll also try and buy us a few minutes and keep it open for Q&A at the end. So what I want to start with a national outlook, which is basically you can sort of kind of translate that into NYMEX Henry Hub pricing. And then what I'm going to do is I'm going to focus a little bit more regionally, especially in the Northeast, because it is obviously still a very winter peaking and highly pipeline constrained area of the U.S. So those are the two sort of regions I'm going to look at. But certainly, if anyone has any questions about the Midwest or the West or the Gulf or South Texas, we can talk about those too in the Q&A. I'm going to start with probably what's going to be a wrap-up for a lot of you here, that we are entering or we are in a very strong El Nino year, right on track with 1997-98. What this chart shows is it shows actually the past 15 or so years, but the two lines that you could actually see there, that's 1997. And then that's 2015. 1997 is in the green, 2015 is in the black. And so we're seeing that the Nino 3.4 anomaly, which is basically how hot that patch of equatorial ocean is in the Pacific, is basically as high as it's been in recent memory. So this is one of the most important indicators to watch for whether we're going to enter a strong El Nino winter here in the States. That's obviously bearish for residential and commercial, so heat and gas demand, right? And I think that the EIA, and by the way, I love the EIA. Someone said recently, I thought it was a great characterization. They're the consultants we all pay for, but I'm really happy to do it. I love the work that the EIA does, and we and others, we all lean on it very heavily, right? So this is from the EIA's latest short-term energy outlook, just looking at and historicals. Just looking at heating season, ResCom, so residential and commercial gas demand. These numbers in the big blue are billion cubic feet a day over the heating season, right? November 1st to March 31st. That's the heating season. And then you see in the black, those are heating degree days, nationally over the heating season. So the EIA is factoring in, that this warmer certainly than the last two winters, but even warmer than the 10-year average winter this year. So that looks, to be, fair. What one sort of open question that we do have is that the EIA is calling for, sort of embedded within this is a sort of increase in the gas intensity, right? So total BCF used per HDD, and that's the lower chart, right? So for whether or not you sort of believe the HDD number or not, it really is a probabilistic thing. It's a stochastic variable. We do think that this number right here, the gas intensity, is probably a little bit higher than it should be. And if we normalize that back to last year's level, we're probably looking at something like 150 or 200 fewer BCF of ResCom consumption over this coming heating season. I wanted to point that out. I want to come back to a couple other areas where we see things a little bit differently on the supply-demand side than the EIA. But broadly, this is our outlook on gas in storage, right? Total U.S. working gas in storage, right? So we can see the range there. We can see sort of what's happened to date. We can see where we think we're going to end up, which is just under 4 TCF at the end of this month, end October. And then we can see where we think we're going to end up end of March. And I think of the two numbers on this chart, which is end of October, end of March, the end of March one is much more important. First of all, we're pretty much, we don't have much farther to go to the end of October. There's no real risk that we're going to, get some crazy storage number that no one expects. there's a lot less consensus around this number, and I think it's for a few reasons. But regardless of what the reasons are, which we'll get into in a second, if we do hit a number like that, we're going to have to do a lot of work to burn ourselves out of the problem come next spring, right? Which is to say that prices will need to drop in order to incentivize power burn, incremental power burn, to basically cure this, situation where we all have a lot of gas in storage, which is a repeat, probably on a somewhat smaller scale, of the situation that we saw in 2012 after the year of no winter, right? After the basically the non-existent winter of 2011, 2012. So I'm gonna sort of harp on that, but that really is the central thesis here. So if you take something away, we're bears, right? Bearish relative to the NYMEX curve. There's just too much gas in storage, and more importantly, too much gas in salt storage in the Gulf Coast. We're gonna have to, even if we have a somewhat colder winter than the EIA is calling for and NOAA is calling for, we are likely going to be left with more gas in storage come April that we're going to have to burn off one way or the other, and via the power sector. I think this is one of the coolest charts. It's like very simple chart. All it is a seasonality chart of NYMEX Henry Hub, or rather Henry Hub cash prices, right? So it's just Henry Hub prices in the 5 years, not including 2015. And what's cool about it is that it really kind of shows how the market prices gas, right? This is one of those basic things, but the more you look at it, the more you realize it has like all the answer to all of life's questions in it. What you notice is that at the end of injection season, the end of summer, so basically October 30th, November 1st, prices have converged to an incredible degree, right around that 350 mark. So the market says, what are we comfortable with? What's our consensus of gas and storage at the end of October? 3.8, 3.9, in trillion cubic feet working gas. 3.8, 3.9, maybe even 4, whatever. We'll get to the number. And then we're going to see what the winter does. And if we have a real harsh winter, prices are going to spike, obviously, upwards. And then through the rest of, what in the trading community we call the JV, that's the summer, J being the contract for March and V being the contract for October. So over the JV, prices will basically move such that you either don't burn a lot in the power sector, so you get back to that 3.8, 3.9 TCF in October, or so you do burn a lot in the power sector. But either way, you're getting back to that same 3.8, 3.9 in storage and $3.50 pricing. That was a remarkably consistent story. So again, here, 2012, sorry for over there, 2012 is the one on the bottom, the year of no winter. That was when we saw $2 prices in April, which we may see again. Last year, polar vortices, and then obviously bringing it back down. This year, we're there. We're setting up for an incredibly weak, price-wise, sort of both winter and then year ahead. So both this heating season and then the JV 16, right? Summer 16. So I think that is a pretty incredible chart because, that was a trend that really was sticking around for a while. I think it's actually a less cool chart, but we can have arguments about that. What these are the green line is just basically the strike price, right? The basically market futures for Henry Hub by month, right? So we can see that the market expects prices to hit the 280s in the peak of the winter, and then come back down to the sort of 265, 270 level. That's where we are bearish, and we are confident about our bearishness. We do not see prices that high. At those levels, you cannot achieve the power burn necessary to get you back to anywhere near a normal amount of storage. Why is the market expecting this? Again, I'm going to talk about it in a little bit. I'm going to break it down because there's some stuff on production that I don't think the market is properly taking into account, and I think there's some stuff on consumption that the market is not properly taking into account. So I'm going to get into the specifics in a second. These are just the probability distributions. I won't spend too much time on that, but the sort of plus or minus 1 standard deviation from the implied volatility of those contracts does indicate at least that there are other people like me around who do see that price dropping closer to the $2 mark. Here's why. This slide and the next slide, and actually, it occurs to me now that I should have reversed it. So let me reverse it. where is production coming from, and where has it been coming from the past few years? The Appalachian Basin, right? Marcellus and Utica, together, the App. The App Basin is, I mean, it's pretty tremendous. Right now, it's producing about 20 BCF a day of dry gas, right? Which is a just tremendous amount, and it obviously is supplying the entire Northeast on its own. You still do have imports into New England, but I mean the Northeast writ large is the Marcellus and Utica's home. It's also already started to export to other states. A lot of people, talk about, Appalachian Basin, pipeline reversals and expansions and exports as if it's something that hasn't happened yet, as if it's something in the future. It's not. It's actually, and by the way, we're low on this by 450 million a day because TICO and Columbia Gulf have both reversed now. That just happened about 2 weeks ago, and I forgot to add to the chart. Mea culpa. But right now, we are exporting 7 BCF a day out of Appalachia to the rest of the country. Where? Well, we've broken down the colors here to show you where. The greens are the U.S. Gulf Coast, USGC, right? Via 3 pipelines, TETCO, Texas Eastern, TGP, Tennessee Gas, and TGT, Texas Gas. Also a good amount to the Midwest. That's the black and gray right there via REX, the Rockies Express, and again, TETCO. That's a TETCO 24-inch through the Lebanon lateral. How many people are pipeline nerds here? Raise your hand if you think if you'd call yourself a pipeline nerd. We got 1. Okay, I'll try to keep it less nerdy, and then some other stuff. But the largest number was to the Gulf Coast, right? The Gulf Coast is interesting. So let me put it this way: there are 3. EIA is actually coming out with a new classification for storage and for storage regions, right? So there will be 5, but right now there's still 3. The East, the consuming West, and the producing region, which is basically the Gulf Coast, right? Within the producing region, storage is further subdivided into salt and non-salt, right? Okay, so back up. The producing East, in the main, as a generalization here, is sort of utility storage. And the utilities don't store, either inject or withdraw gas from storage really for economic reasons. They do it for reliability reasons, right? So every year looks the same, right? They put the same amount of gas into storage. They pull the same amount of gas out of storage. Exceptions to that rule, but in the main, that's the rule. West, similar. Producing region, and especially the salt domes, which have that high deliverability that you can inject and withdraw quite a lot on an intraday or interday basis rather than a once-a-year basis. Producing salt, this is economic storage. These guys are playing the spreads, right? These guys are playing the January-October spreads. These guys are the one going out and betting on their own accounts. So this is really, I think, the much better marker to watch, especially in today's market. And what we see is that we are at record storage levels in the producing salt region. Why? Because that's the last thing left. Because that's the last thing left when there isn't the demand and there's too much supply. And there's nowhere else to put it because the East region guys aren't taking it because they're saying, well, we don't need it. We only need what we need, and go find another home for it. Prices aren't low enough now for the power sector to take it, right? That's why they've been dropping and why they will probably continue to drop. Only thing left is the salt on the end of those straw pipes, and that's what we're seeing right now. So that's sort of the national story broadly. But I want to spend the next few minutes looking more regionally and also looking at a couple of areas where we sort of disagree with the EIA on the outlook. I guess really there's really 3 areas, and 1, 2, 3 on this chart. One is probably not it's not that big of a deal, but it's worth mentioning, which is the industrial. Industrials were very disappointing. Industrial, by the way, is like a mishmash of a whole bunch of things. It's a whole bunch of stuff behind the city gates, but then also on people who buy wholesale gas, it's big ammonia plants, petroleum refineries, ethylene crackers, methanol facilities, steel plants, DRI, all that stuff, right? Anyway, that was kind of disappointing. And we heard a lot of things. We heard like, oh, it's the strong dollar. Oh, it's this, that, and the other thing. We thought, and I think the data is bearing this out now because we've seen a recovery over the past 2 weeks, that it was turnarounds and idlings of large facilities before expansions, right? So there's an ammonia plant in Iowa, a big giant ammonia plant in Donaldsonville, Louisiana, that turned around, but they turned around only because they were adding capacity, not because they were taking capacity offline in any permanent basis. So anyway, we're a little bit more bullish on industrial. Not a huge story though. Number two, like I said, EIA is the greatest of all time. You guys are the GOAT among all the agencies. But I don't know where, like October 15, we're exporting LNG right now? We're not. So that's wrong. What it should be is our number right there. But even that, by the way, is there is a sort of band of certainty and uncertainty around that, right? So okay, so it's Sabine Pass, Train 1. That's where we export LNG from, right? That's going to happen. Probably actually will get cargoes out in December, but cargoes like 1-2 cargoes, right? Because there's going to be commissioning work. So I think that what you're going to see is you're going to read the noms, you're going to read the nominations on the pipelines, pipeline nerd, and you're going to be like, oh my God, Sabine Pass is online. Look, it's taking gas. No, that is them doing commissioning work. That's them ramping up their plants, seeing if everything works, and then they're going to, drop the noms the next day, and everyone's going to be like, what happened? That's what's happening. That's going to go on for several months. They're probably going to put those cargoes, that's probably the contract with EDF, that they're going to take those cargoes to Dunkirk and sell them at TTF pricing, so it probably won't make them into Asia. We don't really foresee baseload operations from Sabine Pass Train 1 starting until March or even April. And that is obviously, even though it's only one facility, because it's a 600 or even 650 million cubic foot a day at plant inlet facility, it's going to make a huge difference to the S&D balance. So, it's kind of game of sense there. So, yeah, this one is definitely wrong. I mean, I'll bet you $1 million. Dry production. This is one where I think that everyone has their own view, and everyone's can talk to it however they want. Our biggest difference is that we see a bigger uptick come very soon, probably late October and November, from Appalachia. And then we also see a downturn in production in Northeast Pennsylvania come the next JV, the next April, because we do think that Northeast Pennsylvania is going to start exhibiting production seasonality. But that's where I'm going to spend maybe the next, sort of 10 minutes is on production. Because I think that, other than LNG exports on the demand side, this is the thing that really matters, and it even actually matters more than that. All right, so again, this is all about Appalachia. Why? Because Appalachia is the biggest thing, around. If we want to talk about, the production from the Permian and the Eagle Ford and the Haynesville and the Fayetteville and all the other stuff, we can do that later. But really, I'm focusing on Appalachia here. Right now, those are flows east to west, so exports out of Appalachia on the Rockies Express Pipeline, REX, right? So this is a big thing. Like, the market's obsessed with REX. And I think the market's, there's that old saying about, like, the drunk man is looking for his keys under the street light, right? And he's only looking for the keys because there happens to be light there. They could be anywhere. Right? So it's like analysts love looking at stuff where there's data, and they ignore stuff where there's no data, usually to their own detriment. Rex reports really, really well, and it's super easy, and it's a big straw pipe. So anyway, the point is that after sort of several months of basically being full to the brims, taking as much gas as the pipeline could physically handle, right now we see excess capacity on that pipeline. So a lot of people are looking at the Northeast production, and they're looking at REX, and they're saying, oh, well, we've hit this stagnation point. We're not producing, right? I mean, this is clear evidence that, we're getting, sort of past this plateau point, and 2016 is going to be the year of the great equalization, right? When supply and demand meet again, and everyone's happy, and, producers make money. We do not think that's the case. Really what's happening on REX, this is, I won't get too into this, but it's a map. Well, that's pretty obvious, isn't it? But it's a map of, this is the West Virginia Panhandle, that's Southwest Pennsylvania, this is East Ohio, that's where most of the activity, most of the growth is going to come from in Appalachia. What's happening is that you have open space on these pipelines, and these takeaway pipelines, and for so long the issue has been you don't have any takeaway, right? So as soon as you get space, you're going to flow gas through it. That is true in a lot of areas of Appalachia, but right here, it's actually an issue that's even upstream of the pipe. So it's even in the compression systems or in the compression systems on the gathering systems before you get to the pipeline. That is why you are not seeing production filling up the pipe in REX, at least not for now. The good news, bad news, doesn't matter really, is that basically two massive, one especially massive, but then one also quite large gathering system are getting compression on any day now. October-ish was the most recent estimate. And basically adding compression to those gathering systems gives them the ability to flow that gas over the gate pressure onto REX and onto TETCO and push more gas out of the basin. So production will be forthcoming. It's an infrastructure issue. Don't believe, I don't know, the hype. Don't believe the non-hype. Believe the hype still. So like, believe the old hype. Don't believe that. Don't trust the haters. Production from the Northeast is going to continue to grow over the winter, right? For a lot of structural reasons, most of them having to do with new gathering, but also some new takeaway pipes. This is a new takeaway pipe. It's called the Ohio Extension. It's going to connect into TETCO. And then you have the northeast of the basin, right? Not the northeast of the U.S., but the northeast of Pennsylvania, right? So Appalachia, actually, really, you should divvy up Appalachia into two parts, sort of the northeast and the southwest. Northeast is dry gas, Pennsylvania Marcellus, Susquehanna County, Chesapeake and Cabot, and Anadarko and Shell. The southwest is its own beast, right? You got the Utica, but you also have the Marcellus. You know, you have southwest Pennsylvania, you have West Virginia, you have Ohio, and those are guys like Antero, Range Resources, again Chesapeake, Gulfport, etc. Anywho, this is the northeast, like northeast Pennsylvania, right? This is receipts into one pipeline. It's Transco's Leidy line. The Leidy line was originally built back in the day to connect to storage, to connect New York City markets and New Jersey markets to storage. But now it serves as basically a big pipe that picks up a whole lot of receipts. How many? You had, about 3.5 billion a day coming into that pipeline. And then, and this everyone knew about, you had outages in May of this year. Everyone thought that was going to last a month, and then things were going to pick back up, but they haven't picked back up. And again, this comes back to the sort of don't believe the hater story or still believe the hype story, right? So much of this, we're in this stagnating production environment is due to basically short-term pipeline issues. It's not due to producers curtailing production. Not that that's not happening. There is a little bit of that happening, but I don't think it's a very material amount. Most of it's due to stuff like this. So come Dece 1st, Leidy expansion is not only going to increase the Leidy line capacity by the posted amount of 500 million cubic feet a day, you're actually going to be able to flow the 700 that you're still down off of what you were at. So just out of northeast Pennsylvania, we might see 1.2 billion a day incremental of growth from today. So that's the sort of micro picture in Appalachia of production. More macro, why do we focus so much on Appalachia? Because of this. This is basically year-on-year growth in dry gas production for 4 areas of the U.S. and then the other, right? So how do you read this? Year-on-year, July of 14 was up 4.2 BCF a day. That means in July of 2013, you were at, call it 70. In July 2014, you were at 74.2. So that's your year-on-year growth, all right? As you can see, this is dominated by that green, which is Appalachia. You also had very, sort of a good amount of production growth coming from the Eagle Ford and the Permian, that associated gas. It is true that we are going to lose molecules from oil plays, right, from associated gas. But in the grand scheme of things, it's a relatively small amount. So we can talk about that until the cows come home. But I think the real takeaway is that yes, it matters, but not as much as the bulls would have you believe. The last thing I'll say, and I really won't say very much on it, is that everyone talks about Appalachia, myself included, obviously. People talk about the Eagle Ford and the Permian. It's like everyone's got opinions on these things. Really, the biggest sources of uncertainty are not the big 5, but the little 50, the plays that no one cares about, the plays that no one looks at. There is data, but there's a paucity of it. There's no really good analysis. There's a bunch of different people doing things for different reasons. I mean, it's all for the same reason. Prices are low. But really, this is where the variance is. I wish I had something more conclusive to say about that. But anyway, not the big 5, the little 50. That's where most of the forecast uncertainty is. So I'm going to do one more kind of section here, and then I'm going to close it out. We had the raise your hand state thing before, but I didn't see a lot of people from Texas, which is, I mean, that's okay. I don't know how many people are from Massachusetts, Connecticut. We get it. We got one. Okay. We got a couple. Okay. So Algonquin is Algonquin's like shorthand for the New England gas market, but Algonquin's really a pipe. It's called Algonquin Gas Transmission, AGT, and it's owned by Spectra, which also owns TEPCO and a bunch of other pipes. So this is New England's gas infrastructure. It's obviously not all of it, but it's the stuff that matters really. So AGT is Algonquin, and what you see are the arrows represent the gas flows last heating season, last winter, right? And the numbers are. The smaller number is the average flow last heating season. The number in bold was the peak day flow, peak day scheduled nomination last heating season. So AGT, Algonquin itself, is one of the arteries that feeds New England, obviously. The other one is TGP, Tennessee Gas Pipeline, which is a Kinder Morgan pipe. So those are basically the two big arteries that feed New England with gas. Prices in New England are either TGP Zone 6 or Algonquin. Algonquin's the more liquid hub. They're within a few cents of each other. So Algonquin prices equals New England wholesale gas prices. There's some other pipes on here that we will mention, but I just want to sort of there. I feel like I'm really not getting any love on that side of it. Not giving any love. But all the way then to the east, that's where LNG comes in basically, and that's a very peak shaving type phenomenon. I don't mean peak shaving like the utility peak shaving. I mean it's only a few days a year. So broadly, this is how Algonquin pricing works. And really any constrained demand market pricing works. You get cold temperatures. That leads to high demand. That leads to constraints in the pipeline network. That leads to high prices, which are basically spiking prices, very nonlinear, and that leads to one of two things, or both of two things: gas to fuel oil or distillate switching, and LNG imports. And someone said earlier we don't really have any oil-burning plants in the country anymore. That is true. The exception is clean and green New England still burns fuel oil. So I'm going to tell you why over the next 5 minutes that the market is tremendously, what I would say, although less tremendously than it did 6 weeks ago, overpricing New England gas this winter out of fear, autocorrelation, and the I don't know factors. But before I do, let's look at last winter, and let's really put this logic map to the test. Now, I color coded it, which because I'm such a nice guy, but we're gonna put this stuff in action. So what happened last winter? Well, in New England, in New York and D.C., it wasn't so bad, right? It wasn't as bad as the winter before, but New England was actually worse in the later part of the winter. So what happened was, when the temperatures went way down, system demand on Algonquin went way up. You hit capacity on your pipelines, and prices started to spike, right? And then especially there, when they couldn't get an LNG cargo in, prices hit $30, right? That's basically how the market functions. So why is this year different? Why is the market overpricing Algonquin this year? One thing is that so there's really two things you got to think about. Well, it's a spiky market, right? It's nonlinear pricing, right? So it's either you're trading basically at Henry Hub pricing or $5 above it. It's very binary. So when we think about this, what we do is we'll think about the frequency of price spikes, which is how many times prices spike, and then we'll think about what will they spike to when they do spike. And that's the way we think is the best way to analyze basically New England gas markets. So in another slide, because it's super nerdy, we ran a logistic regression, actually a series of logistic regressions, and we determined how many, given NOAA's outlook on temperatures this year, how many price spikes should there be, right? And it's fewer than last year is the short answer. And then we said, what will prices spike to? And this is sort of really, really, no matter what you think about temperatures, because no one really knows, you got to be short Algonquin. Because what are prices spiking to? They spike to either LNG or oil. And both of those are much cheaper than they were last winter. This is basically This is distillate fuel oil. Residual fuel oil is even cheaper. So distillate right now is about $11.50 delivered to Boston per million BTU. Resid is about $7.50. Spot LNG is about $7.50 or even closer to $7 now. So, whereas last year you might have had to spike to $12, $13, $15, for LNG, this year you don't have to spike to much above $7 to get hold of that incremental gas or incremental negative molecules of gas by oil switching. So this was as of 3 days ago, or not 3 days ago, as of Friday's close, Monday's close? I don't know. It was recent. That's basis Algonquin to Henry Hub. That says in Jan and Feb, you're going to be almost $7 above the hub. So if Henry Hub prices are $3, which they're not going to be, but suspend disbelief, then you're going to trade $10 Algonquin, right? We think they should be under $5 above the hub. So Algonquin basis, there's still a buck plus of what we can describe as asymmetrical risk, which is that you're an LDC, you have an obligation to serve. That's number one. Number two is at lowest cost. But really, I think it's the fear, and I think it's the natural autocorrelation phenomenon that what's the weather tomorrow? Well, it's the same as the weather today, and that's usually the best answer you can come up with. So anyway, this will change going forward. I don't want to sort of belabor this because it's a little bit more long term, and I sort of also want to open it up and get to some questions. But the Algonquin basis problem will hopefully get solved by 1 or 2 new pipelines in the pretty near future. And I think, one more thing, and then I'm going to leave it. So I think that we, as market analysts, when we think the Northeast, we think Algonquin because that's where all the volatility is, and that's where there's a decent amount of liquidity. So that's where you can play, right? If you're trading gas, like that's where you want to be. New York is another issue. I only brought this slide to emphasize one thing that a lot of people will tell you that New York this winter it's going to be so great because we put in this new massive project, the Rockaway Lateral, that's going to deliver off of one of Transco's laterals into Nat Grid's territory in Brooklyn, Queens, and Long Island. It's not. It's incrementally, it's only 100 million a day. It's advertised at 650, but basically there's, downstream it's 650, but upstream it's only 100. So we can talk about it more. I feel like I don't want to get into too many weeds here. So with that, I'll close it. I'll close it by saying we're bearish Henry Hub. There is almost no pressure to the upside. There's offers, and no bids. We're also bearish for the Northeast, but for different reasons. It really doesn't have anything to do with the U.S. market dynamics as much as it does with international market dynamics. And there you go. So we'll have a Q&A now. No cues. Okay. Well, I bought us some time, right? Thank you.
I have a question in the corner about, so what's your prospect for LNG imports into New England? A total spot market, but doesn't look like the price is really going to be there for LNG coming into the New England Northeast market this winter.
Well, you still have you're still pretty deeply in the money taking LNG into New England. At $7 basis on a $2.50 fixed, you'll make money on that. The issue I think that I myself, was guilty of, last winter was that thinking that the LNG markets are this nice open market, like thinking that LNG terminals are like a pipeline where they're open access contract carriers. They're not. GDF owns the option for Everett. They got slots that they're not going to let you into. They'll let themselves into it, but that depends on what financial position. Are they long Algonquin or are they short? So what physically will benefit their financial position? That's what's going to dictate what slots on Everett get utilized. Repsol has the same thing up in Canaport. We have started to see Canaport contracting open up, so I do think that there could be more in Canaport. It's a little bit more. It's a little bit less opaque than Everett. And then Accelerate is doing its contracting now. And actually, I got to go back and look at the contracting on that section of Algonquin that feeds from Accelerate. It's called the hub line. Yeah. So I got to go back and look at hub line contracting, which I meant to do actually yesterday. But there will be LNG. It's in the money. There should be LNG, and there will be and has already started to be signs of more at Canaport. I can't answer the question with the data that I know right now at Everett or Accelerate. And Accelerate has really tight gas spec too. So there's issues. You know, it's not really a commodity. You know, gas is a commodity, but and LNG is a commodity, but it's either your ship size matters and then your gas spec on your ship matters too. Okay, this time's for real. Huh? Yeah. Huh? Oh.
Is there any thought of shipping natural gas plus liquids, say like what Alliance does from Canada over to Illinois? Is there any thought of doing that instead of just separating out the liquids? Is there any pressure or thought about that?
From where to where?
From the Northeast, in other words.
From like the App Basin down south to the Gulf?
No, actually, they were talking about corn dryers and other types of
Oh yeah.
equipment that uses propane, butane pretty much exclusively.
Yeah.
So whether or not is there some question about doing that?
No. No. The line there's sort of a hybrid, but I mean no, you never ship. Alliance is unique in being a rich gas system. And TGP still wants to convert one of the lines of the TGP pipeline. So Kinder Morgan wants to take one of the TGP lines that runs through Ohio that's currently basically the null point on the system, so is being underutilized, and convert that into Y-grade NGL service. But then that would be a line just dedicated just for NGL service, and that line would run down to the Gulf and at the Bellevue area crackers. So we wouldn't do that. And I think basically with all the de-ethanization capacity standalone that you have up, that MarkWest is building up there, the only thing you could ship would be C3+, and you'd tank that to the Midwest. Cool. Thank you.